In our globalized world, we often encounter different currencies. Each country has its own form of money, and when we travel or do business internationally, we need to exchange one currency for another. A currency exchange rate tells us how much one currency is worth compared to another. These rates are constantly changing, reflecting the economic conditions of the countries involved. Think of it like trading cards. Some cards are rarer and thus more valuable than others. Similarly, some currencies are stronger and more valuable due to their economic stability and global demand. Currency values fluctuate constantly, influenced by various factors like supply and demand, political stability, and economic performance. When demand for a currency is high, its value increases just like popular trading cards. This can happen when a country's economy is doing well, attracting investors and boosting the currency's value. Conversely, when demand is low, its value decreases. This can occur during economic downturns or political instability, causing investors to lose confidence and move their money elsewhere. Understanding these fluctuations is crucial, especially during economic uncertainties. By keeping an eye on currency exchange rates, businesses and travelers can make informed decisions and potentially save money. Economic crises, often characterized by recessions or financial turmoil, significantly impact currency exchange rates. These crises can stem from various sources such as banking failures or stock market crashes. One way is through inflation, where prices of goods and services increase rapidly. This inflationary pressure can be exacerbated by panic buying or hoarding. During crises, inflation often rises due to factors like reduced production or disruptions in supply chains, leading to shortages. This erodes purchasing power, making the local currency less attractive to foreign investors, leading to a decline in its value. Additionally, crises often lead to job losses, increasing unemployment. As businesses struggle to stay afloat, layoffs become more common. Governments often intervene during economic crises to stabilize their economies and currencies. They might lower interest rates to encourage borrowing and spending, aiming to stimulate economic activity. However, these actions can sometimes backfire. If seen as desperate, they might lead to further depreciation. The 2008 financial crisis offers a prime example of how economic turmoil impacts currencies. It was a period marked by extreme volatility and uncertainty, shaking the foundations of the global financial system. The crisis, originating in the U.S. housing market, triggered a global recession. The collapse of major financial institutions and the bursting of the housing bubble led to widespread economic distress. The U.S. dollar, considered a safe haven currency, initially strengthened as investors sought stability. This was a common reaction as investors moved their assets to what they perceived as safer investments. However, as the crisis deepened, the dollar weakened due to concerns about the U.S. economy. The initial flight to safety was overshadowed by growing fears about the long-term health of the U.S. financial system. Similarly, the Greek debt crisis beginning in 2009 saw the euro, shared by Greece and other European nations, face significant pressure due to fears of a Greek default and its potential ripple effects on the eurozone.